Hi, welcome to Victor Growth Classes. My name is Vijay Sir. In this class, we are going to completely cover the very important topic in economy, monetary policy. Okay, monetary policy reviews have been done. The RBI has given the important points about monetary policies, and it has come just after the budget. So it's a very appropriate time to learn the economy. Already I told you that I'm going to take economic survey also, and some of the classes I already recorded. We'll be getting it soon. Budget I have taken. So this is a good time to learn economy. You have got budget out, you've got economic survey out, you've got a monetary policy out. Okay. So some people will feel economy is tough, but I don't think so. Okay, you may not be taught properly. So we'll try to do our best. Okay. So let us get deep into it. So the engine of stability. Okay, monetary policy in India, framework tools, and February 2026, okay, along with the budget, MPC. Okay, MPC means what? Monetary Policy Committee. That is a committee under the RBI, and they have got certain responsibility. We'll discuss. Okay. Then what are they talking about? Liquidity management. Liquidity management. Okay, I'll try to explain every word. Still, if I have missed out, you can ask me. Okay, liquidity management means how much money should be available in the country. So liquidity means cash availability. Okay, liquidity management means how much of cash available with the people. That is what they mean. Exchange rate stability. Okay, exchange rate stability, they don't have direct connection because we have got a floating exchange. That means the market will determine the exchange rate. Okay, but still the actions of the RBI will impact the exchange rate. Okay, for example, rupees appreciating or depreciating. Recently, what happened? India and USA made a deal where the tariff is reduced to 18%. That means our export to the US will increase. The export to the US will increase, and because of that, rupee has appreciated. Okay, so those are the actions you should understand. Okay, inflation targeting, very, very important part of the monetary policy. Okay, the normal inflation which we are targeting is CPI. CPI means Consumer Price Index, which should be 4%, 4% with plus or minus 2. Okay, please note down. I hope you are understanding this. If you are not understanding, please let me know through the comment section. So these are the certain aspects of monetary policy. Liquidity management, how much cash should be available. Okay, exchange rate stability, not directly impacting, but the actions will influence it. Okay, then inflation targeting. Okay, normal inflation we are targeting is 4% with plus or minus 2. That means it can plus 2 it go to 6, minus 2 it can go to 4. Okay, but now I cannot believe, okay, the government is saying, the data is saying we got a inflation of 1.7%, but when I go and buy butter, jam and all, okay, it is very costly. Vegetables you cannot speak about. So I think there is some problem in the statistics, and not necessarily there's some doctoring happening, but the base effect, okay, or the basket of goods may be a problem. Okay, now status report, February 2026 decision. Okay, the first policy decision following the budget, I told you budget was presented on 1st February. It has come after that. So they are saying that we are doing a neutral stance. What do you mean by neutral stance, sir? Neutral stance means they are not increasing or they are not decreasing. They are maintaining status quo. What they are not increasing? They are not increasing the rates. They are not decreasing the rates. What rates they are not increasing? Repo rate they are not increasing. Okay, reverse repo they are not increasing. SLR they are not increasing. CRR they are not increasing. Okay, so they are maintaining a neutral position, signaling confidence in the economic resilience. Okay, resilience is a very important word I told you. That means something is going in trouble. Okay, you are making it stable, and then you are making it growth. For example, with India and USA match, if you have seen, okay, within 3-4 overs, okay, for 4-5 wicket loss, 4 wicket lost, I think. Okay, so it was in trouble. Okay, then Surya Kumar Yadav comes and he slowly takes singles as possible. Then he charges. Okay, he attacks and he brings a respectable score, you can say. Okay, that is known as resilience. Resilience means something in trouble, but you are holding it, you are correcting it, then you are increasing, accelerating it. Okay, so we have economic resilience in that the RBI has got a confidence, thereby they need not, normally we expect them to reduce it, but because inflation is already 1.7%, no need to reduce. In fact, they should increase it if at all, but I don't think they'll. So neutral stand means they are not doing anything. They are status quo, they are maintaining. Repo rate is unchanged at 5.25%. Okay, then they are also saying that the GDP growth will be 7.4% projected. Okay, and the inflation target is 4%. Okay, that means they are expecting to be 4%. It is below the 4% is what the reality. Okay. That means we are having cheaper goods, we are having a cheaper services, vegetables are cheaper, which is what the government is saying. Okay. So, who is the governor? Sanjay Malhotra describes the current status quo better than the Goldilocks sweep sword. Okay, I don't know what is that. No need to know also. Okay, strong growth momentum driven by recent. Okay, that is okay. Like, that is something I told you. Okay, see, all things are dependent. You can say. Okay, see, for example, Trump says that you are buying Russian oil, so I am putting a tax of 50%. Okay, and he's saying to Europe, saying that you are not giving me Greenland, so I am also going to increase your tax. Okay. So then, because of that, because of this US pressure, India and European Union comes and makes a deal. Okay, FTA, free trade agreement, 0% tax. Now, looking at the pressure, USA comes and says that I'm reducing the tariff to 18%. Okay. Now, once they reduce the 18%, our rupee is appreciating. Understood? So all these are dependent. If you don't understand, please you can ask me again. Okay. So mandate, what is the mandate? What is the primary objective? Okay. Balancing prices. That means the price of the commodity should be at the reachable to the people. It should be affordable to the people. It should not be really high. Okay. It should not be really cheap also. Okay. So balancing the prices is the important mandate of the monetary policy. Prosperity means basically economic growth, which is actually the dilemma of RBI, which both cannot go in hand. Please write on your notebook. Economic growth is always coupled with the inflation. Economic growth is always coupled with inflation. That means whenever economic growth is happening, inflation will also happen, sir. Understood? So, what is that? So, RBI is confused. Should I look at the growth or should I control the inflation? In this place, you have to remember one person committee, Nachiket More committee. No, Nachiket More committee is about small banks and the financial inclusion. The other committee is Urjit Patel committee. Okay, my memory is not bad, guys. Okay. Urjit Patel committee, he recommended that the MPC, Monetary Policy Committee, should focus on the inflation. If the inflation is under the control, automatically the growth will happen. Okay, so that is why little bit they are targeting the inflation, you can say. So primary objective to maintain price stability. Price stability means to keep the inflation in control. Okay, while keeping the main objective of growth also. Okay, operates under the flexible inflation targeting adopted in 2016, which I told you already. Okay, it is written here. Okay, 4% plus or minus 2. Okay, at the same time, let's look at this. If the inflation is increasing, the GDP growth will come down. If the GDP growth is increasing, the inflation will come down. That is what the traditional dilemma of RBI, what to do, but they have to do this. So being an RBI governor is not easy. Okay. Secondary objective, okay, exchange rate stability. Please write down what is the objective of monetary policy. Okay. Primary objective is to control or regulate the inflation, to promote growth. Okay. Exchange rate regulation, which is not directly possible because we are not having a managed currency. Managed currency means we will fix what is our rate. That is done by China and all. That is where depreciation they will do, devaluation they will do. Okay. But it's a floating currency. The market will determine. Okay, financial stability. That means credit growth, credit availability. All this credit means loan availability. Okay, the architects of the Monetary Policy Committee. Okay, so who are the members of this? There are total 5 members are there. Okay, look at this. One is RBI governor is there. Okay, he's a chairperson. Okay. Did I say 5 members? Okay, I think 6 members. Okay, Deputy Governor, Monetary Policy. The RBI will nominate one more person. So, 3 members from RBI, then 3 members from the government also. Okay, look at this. Member 1, 2, 3. I don't know who are going to be there. Okay, appointed by the central government, 4-year non-renewable term. Very good. Okay, that means once 4 year you have been a monetary policy, you have to get out. Okay, so 6 members are there. Okay, 6 members, and they'll take a decision on the voting. Okay, anything they want, they can vote, and majority they will vote. Okay, now you can ask me, sir, these 3 members are saying yes, and these 3 members are having no. What to do, sir? What is the decision will be taken? Now you should remember the casting vote which we discussed in the speaker's case. Okay, so the RBI governor has got one casting vote in addition to the normal vote. So he will vote. Of course, he will take what is the stand of the RBI. Okay, so he has got a casting vote. Thereby, they will break the tie. Okay, the 6 members unanimous decision into the. So it is very rare. Okay, previous governmental decisions will not be. So unanimous, everybody is saying yes. Okay, meets at least 4 times in a year. Please write down. This is one important information. Okay, 4 times they have to meet. Monetary Policy Committee has to meet. Okay, and requires at least 4 members to as a quorum. Only then they can pass the decisions. Okay, this is a trivial information. Not necessary for the economy as a whole. Okay, liquidity corridor. Liquidity means the moment I say liquidity, you have to say cash availability. Okay, managing the cost of the money. That means what is the interest rate for getting 1 lakh money as a loan? How much cost you are putting it? That is interest. That is what. Okay. So now marginal standing facility or the bank rate. Okay, what is this? Both are this. Okay, in which the banks are borrowing money. Okay, so that rate, that means when you are borrowing money, you have to pay some interest, right? Okay, that rate is kept as 5.5%. It is little above the repo rate. Okay, so repo rate is also lending only, but that is from the RBI to the banks. Please write down. Okay, repo rate, basically repo means repurchase. Okay, repo means repurchase. Okay, repurchase. So what are they repurchasing? Government securities they are repurchasing. Who is purchasing? RBI is purchasing. So RBI will purchase it, and in return they'll give you the cash, because the government securities act as a collateral. Okay, so that is so repo rate is at 5.25, whereas the marginal standing facility and the bank rate, okay, that and all 5.5, because that is the basically a punishment rate, you can say penal rate, you can see it's written here also, you can see. That means they want you to keep the money properly. That means bank should have proper money with themselves. They cannot always run, give me 10 rupees, give me 20 rupees, I want to give the person. So if you are going around using bank rate and MSF and all, then you are not keeping your house properly. Okay, then we have got standing deposit facility, reverse deposit. Standing deposit facility is nothing but the this one where you can deposit the money to the RBI. Okay, you have something like reverse repo rate. Okay, whereas the RBI will accept the cash. Is it? Yes, RBI will accept the cash, and they will give the interest to the bank. So if you are ICICI Bank, okay, ICICI Bank can take tons of loads of its money and keep it with the RBI, and RBI will pay them interest. Now tell me, will the bank will do this? Some banks will do it because it is a safe banking, but it is actually lazy bank, because interest rate will be very low. Okay, it will be lesser than repo rate. Okay, so look at this. This is 7.45. This is 5. This also possible as a one MCQ. Okay, arrange the following in the increasing or decreasing order. This is in tandem. If they are increasing the repo rate, then bank rate will also increase. If they are increasing the reverse repo rate, so like that automatically. Okay, so reverse repos is the lowest interest. That means the RBI has to give the interest to the banks in their deposit. This repo rate is a reverse. Okay, the banks have to give the interest to the RBI. Then the bank rate is that wherever they're collecting the money, they have to give. So basically that is a penal account. So if you understand this, it is better. Otherwise, please revise this and read. Okay, and you can always read from the NCERT. These are very basic NCERT books. Okay, now solvency safety net. Okay, solvency means basically when you don't have money. Okay, before a bank can lend to the economy, it must first fill the regulatory bucket. Okay, it's not like tomorrow you started a bucket. You started a bank with 1,000 crore. Okay, so you can give all 1,000 crore in the loan. Okay, and you can collect the interest. Not possible. Okay, it is mandate for the RBI that you have to keep certain money set aside, which is not possible to lend. Okay, one among them is CRR, cash reserve ratio. Okay, this is a cash deposited directly with the RBI. Okay, there is no interest for this. Okay, higher the CRR, lower the liquidity. That means it is normally 4%. Okay, if they increase to 5%, then out of this 1,000 crore which you had, okay, from that you have to increase the more money you have to keep with the RBI. Okay, so please copy down this. Cash reserve ratio is a hot cash. That means it cannot be in any other form. It cannot be gold. It cannot be government securities. It has to be only in the cash. That has to be deposited with the RBI. There is no interest for that, but still you have to maintain that money with the RBI. That is a must. Okay, and higher the CRR, lesser the liquidity. If the CRR is reduced, then higher the liquidity. Okay, SLR means that is a statutory liquidity ratio. liquid asset it can be with the bank itself. No need to deposit with the RBI. It is normally around 19%, not 14, okay, 19%. Okay, and in this you can keep gold also, government securities also, cash also you can have it. Okay, cash, gold, government securities you can have it. Okay, you have to set aside. This is also not available for lending. Okay, that means I'll make things very simple. So you are a bank, you are starting a bank with 100 rupees. Okay, around 4 rupees you have to keep as a cash in the CRR. Okay, around 20 rupees you have to keep as a SLR. Remaining, how much? You are good in mathematics, 76, you can say 76 rupees only you can give as a loan. In that also, you cannot give to everybody whatever or whoever you want, because there's another concept called priority sector lending. Please don't scold me, sir. You are always introducing something in between. Okay, it can be taken, it can be learned, no issues at all. Don't worry. Okay, so CRR you have to maintain with the RBI, SLR you have to keep with yourself only. In addition to that, there's something called priority sector lending. That means you have to give 18%. One example I'm giving: education sector is also priority lending. This agriculture, 18% you have to give loan to agriculture, like that. So as a mandate also. Okay, so these are the minimum things you have to follow, banks have to follow. Okay. Now, managing the system of liquidity. Now, one thing you have to understand is there's a word called transmission. Okay, monetary transmission. Okay, again, don't scold me. Okay, please write down. We'll learn. Okay, monetary transmission. Okay, what is monetary transmission? Is RBI is reducing the interest rate. Okay, RBI is reducing the repo rate. RBI is reducing the CRR. Okay, that means what? Okay, there is a more liquidity should be available in the this one, right? With the country, with the people. But the banks will not reduce the interest rate. Yes, it is possible that RBI will reduce the interest rate, but the banks will not reduce the interest rate. That means it is an incomplete monetary transmission or inefficient monetary transmission. The monetary transmission is not reaching to the people. Okay, and believe me, the RBI also cannot come and say that you have to reduce the interest rate. Okay, I remember one of the monetary policy, I think the last one IAS officer, I forgot his name, RBI governor, before this Sanjay Malhotra, who was that? He has said after press conference, okay, saying that we have observed that the banks are not reducing the interest rate. Okay, then reporter asked, "Are you asking the banks to reduce?" He says, "No, we are not asking the banks to reduce, but only we are saying they are not reducing." Understood? That means he cannot. Micromanagement is not possible because RBI is also a regulator. Okay. So in that case, the RBI have to achieve its target of increasing liquidity. They have another option called open market operation. Okay, open market operation, they can buy the government security or they can sell it. Either buying or selling of bonds is known as open market operation, because the banks are not doing it. Fine, I'll take care of my self-healing, I'll do it. Okay, what is this is, when they are buying the government securities, the banks or the public can buy from them. Okay, so when the RBI will buy from them. So RBI will get please note down very clearly, little tricky. Okay, the RBI will get the government securities. In turn, they will pump the cash into the economy. Getting the point? They'll pump the liquidity is injected into the economy. Okay, whenever the RBI is buying the bonds in the open market operation or OMO, the money is injected in, liquidity is injected, cash is into the economy. Okay, the reverse is also possible. They will sell the bond. Okay, they will sell the bond. Okay, so bond will come to the market. Okay, the rupee will go to the RBI's wallet. Okay, that means in that liquidity is absorbed. Okay, they'll take the money out of this. So both they can do under the component called open market operation. Okay, recently, that means before this monetary policy, they have the latest one is February 2026, right? 2 years month before the December, I think they had that time they reduced the repo rate, and also they have done 80,000 crore. They have done OMO. It means they have pumped money into the economy. Then market stabilization scheme, okay, used to sterilize excess liquidity from the capital inflow by selling the market stabilization bond. Now this is something different. It is always possible that any FDI, okay, is coming from the market, from the another country. Okay. Now this is not under the RBI control directly. For example, now we have opened the insurance sector for 100%. So more companies from abroad will come and they will set up the insurance company. So when they are bringing cash, they'll not bring as a Indian rupee. So they'll bring as a dollars or something, whatever they are, so mostly dollar they'll bring it, and they'll come and give to the bank in India. Okay, and that bank will convert that into Indian rupee and they'll give them to start the business. Now this money has been additionally added into the economy, right? The RBI was thinking, okay, I am releasing, we are getting that, but FD can also increase the FDI also can increase the money circulation, right? So when the money is more, what happens? Inflation will be created. Okay, so they have a mechanism called market stabilization scheme. Okay. Whenever the capital inflows is there, that means more currency has come into the economy. That time they use the process called MSS, that means market stabilization scheme, to absorb the shock of FDI or any kind of capital inflows. Okay. That is same as the open market operation. Okay. Now, so far we have seen the quantitative measures. Now come to the qualitative measures. Okay, that means it doesn't mean that this much amount of money. Okay, but rather aesthetic. Okay, for example, margin requirements. Okay, margin requirements. That means you cannot have this much of loan exposure to certain sector. Okay, moral suasion. Okay, moral suasion. They will announce, okay, you guys are not following the rules. Okay, we will punish you. Okay, and that is moral suasion. Okay, that means you can say a decent threatening. You can say, okay, priority sector lending. I told you, agriculture, housing, and all. Mandate. That means the bank, either private bank or public bank, both have to follow this priority sector. One such example is 18% they have to give to the agriculture sector. Then education sector and all, they have to give certain loan. Now renewable is also coming under the priority sector. Okay, direct action. You guys are not following, I'll put a punishment. You have to pay the fine or your license will be cancelled. Okay, so all these are known by the qualitative measures. Okay, it is just threatening. They are making them in the proper channel, disciplining them banks. Okay, so margin requirements, moral suasion, priority sector lending, and that direct action. Okay. Now, what is this RBI's neutral position means? Basically, the RBI is not committed to hiking or cutting. It is not increasing or it is not decreasing. Policy is purely data dependent, balancing strong growth with inflation risk. Okay, some inflation risk is there. 4% is anyway they are okay with that. Okay, I think last year and all it was 6% was there. Okay, so they are okay with, so they are not increasing or reducing it. Okay, so transmission I told you already. Okay, from the policy when the RBI is going to the real economy. Okay, so repo rate is changed means the banks will first take the impact. Okay, so repo rate means increased. Okay, so bank will also have to pay more. Okay, and they will transfer that increase in the interest rate to the people also. The people also has to pay more. Okay, and if they are reducing it, it is opposite. Okay, so this is what the channel was from the bank. Okay, in the lenders, that means our customers. So if you have a deposit, fixed deposit, that is good. When the interest rate is increasing, your deposit will be increasing. Okay, but if you are taken a loan, you have to pay more EMI. Okay, and so thereby this will happen. So the repo rate or changes done by the RBI will impact the people directly. Okay, then what is the impact on the inflation? If the more the liquidity, please write down, more the liquidity, higher the inflation. More the liquidity, higher the inflation, because more the liquidity, more the demand, and thereby more the price of the commodity. Okay, this is what. Okay, so interest channel's primary path of transmission operates along and variable, but this transmission may not happen. That is where they have to come into the open market operation. Okay, now that means I'll ask you one more question. If they want to control the interest rate, what they will do? They will increase the interest rate. They will increase the rates. Okay, if they want to promote the economic growth, then they will reduce it. Okay, this also you should understand. Okay, so why they are holding it 5.25%? Okay, US deal is more, so export is possible more. Okay, strong GDP 7.4% we are expecting. Resilient demand. Okay, one thing they have not given here is inflation is also under control. Okay, is for 1.7% they are saying. Okay, so these are the reasons. Okay, headwinds means which is creating some kind of trouble. Okay, geopolitical tensions are there. Energy price is problematic. Okay, precious metal, gold and all increasing price. These are something threatening disturbance, you can say. Okay, but there are certain positive because of that. RBI thinks that we can hold the rates as if now, but there is an inflation risk also possible in the coming years. Okay, so with the growth secure, RBI can afford to wait and watch inflation need, depending on this, needing to stimulate. Stimulate means they want to pump the economy. Based upon that, they can do. Basically, now this is February. Okay, if you go to March, April, 2 months, if you are able to withstand, by June we'll get a monsoon. Monsoon is basically as Finance Minister of India. So when the monsoon is coming, the price will come down. So that is something RBI will look for it. Okay, so I don't think in near future they're going to increase. If at all possible, next RBI meeting they may even reduce the rates. Possibility is there. Okay, so I'm not what is that economist, pure economist, but because preparation for UPSC, you get this knowledge. Okay, let us wait and see. So this is what the monetary policy. If you have any doubt, please comment. Please follow our Telegram channel so that you can get the PPTs on this. Okay. Thank you and see you in the other classes. Bye bye.